I want to start perhaps with you, Todd, for just a quick state of play on how you think things are developing within the ETF marketplace right now. What exactly are the things that have stood out the most to you as we are now about 10 and a half months or so into our 2025 year?
Well, as of the end of October, we had $1.11 trillion of net inflows into the year. Now I'm going that precise because we are roughly $100 billion off of net inflows as a record, 2 months ahead of schedule. So we hit $1.12 trillion for all of 2024. Said another way, 2025 has been the best year we've seen for the ETF industry. On an individual product level, on equity, on fixed income, we've seen gold, we've seen crypto. It's hard to find an ETF that's out of favor with investors, and it's a great time to be an ETF investor.
Anna, this is an interesting time for sure because of the record levels that we've seen flow into the ETF business. From your perspective, as the chief business officer of one of the biggest issuers of ETFs out there, in terms of what has stood out to you, where exactly are you seeing the most development happen within ETFs, and where exactly is the investor traffic going towards as we close out 2025?
Sure, that's a good question because we need to divide between secular trends and new trends. Looking at secular trends, we always follow the money because money never lies. Low-cost beta has been attracting almost a half of the new flows in the industry, so almost $500 billion of new money into this industry are now captured by S&P 500 exposure sectors, so single basis points exposure to segments of the markets. And then we are looking at new trends. New trends are all around income, digital assets, cryptocurrencies, income, but also private assets. So that type of innovation that is going to complement and supplement the low-cost exposure to the market.
Just how quickly, Anna, if I could follow up, just how quickly are those other parts of the market growing for ETFs? You mentioned things like digital assets and cryptocurrencies. You mentioned some of the commodity stuff that's going on, some of the other product innovations around private credit or income generation strategies. Where does State Street see the most activity? Where is the most innovation coming from to meet that investor and trader demand?
Well, you know, we have been really vocal about private assets because we do believe that there is a need for investors to diversify and then receive access to private segments of the markets. Our story has always been around democratization, so opening the doors for investors to really participate in the growth of the markets. So we have done a number of partnerships. We are partners with Blackstone. We are partners with Apollo. We are partners with Bridgewater. And we have seen these products, whether in CLOs or private credit or giving exposure to the all-weather strategy from Bridgewater, really accelerating in terms of flows. Our all-weather ETF has crossed the $600 million, and it's on track to hit $1 billion in the first 12 months of its existence. We have also seen our, PRIVE, our public and private asset ETF, registering a very healthy flows in the month of October, which to us signals an appetite from RIAs or other investors to really participate in the growth of private credit. So to us, this is an acceleration of the new trends. Now, we also need to recognize that markets have been really strong. So in the last few months, I would say after Liberation Day, investors have been wearing risk-on hats, which has really accelerated the development of these new trends.
Now, Todd, it's interesting because for many of these strategies, they're not straight up S&P 500 index following strategies, not even ones that are sector specific for the S&P 500. They are ones that are, I wouldn't call them frontier type assets, but they're ones where they are relatively new to the broader range of retail investors out there and even some institutional investors on the RIA front. From a fee perspective, Anna mentioned how the low cost theme has been something that they've seen develop quite a bit over the course of this year. How much is that fee story resonate with traders and investors when it comes to higher, say, volatility or higher potential return type instruments like the ones we had just talked about?
So Anna covered it well. There's two ends of the spectrum. There's the low cost and crowd, people who are very fee conscious. And so SPYM, which is one of the S&P 500 ETFs that State Street offers, is about to cross a key milestone of $100 billion. It's on the cusp of that. It's seen strong inflows in 2025. So have some other S&P 500 based products from Vanguard and from iShares. But investors are willing to pay a little bit more for the complement to their portfolios. So Bitcoin-oriented ETFs are priced at a premium to what you'd find for S&P 500-based products. We've seen the private credit-based products, again, a similar higher premium because you're providing access to an area of the marketplace that is harder to obtain. And so the last time I was on with you, we were talking about the Simplify Private Credit ETF, PCR. That's another example of ETFs that are helping to innovate within this space. There's room for both low-cost products and products that are a little bit more complicated, offering you a unique area. And then, of course, there's actively managed ETFs, some of which charge a higher premium.
Now, Todd, to follow up on that point, at what point right now do you feel as though we are in terms of the game, innings, so to speak, for just how much investors and traders in some of these newer types of ETF products with newer strategies will be willing to look beyond some of the basis points that are charged in fees towards the underlying strategies and the performance? And when will we get to a point? How far are we away from a point where investors are going to be saying, hey, you know what, for some of these cryptocurrency type tracking products, for some of these private credit products, I really am going to pay attention to just how much in fees I'm paying that impact my return overall?
So I think if it's a relatively simple strategy tied to an index you're familiar with, or it's not even an index. So S&P 500 or gold, GLDM is among the cheapest of those gold ETFs that's gaining traction. Fees matter. For other areas and other asset classes, thematic strategies, for example, come to mind. We've seen strong interest in thematic ETFs that are charging 50 basis points, 65, 75 basis points. NUKZ is a nuclear energy ETF, for example, that has seen a lot of popularity this year. And it's benefiting from that AI trend, but a more complementary way of getting exposure. So I think fees matter if you're building a portfolio of core strategies and nothing else. If you're complementing that with other areas, alternatives, thematic, even actively managed strategies, it matters what's inside the portfolio much more than just how cheap this portfolio is.
Anna, one of the things that a lot of folks have been paying attention to these days with markets kind of at or near these record high levels for not just the S&P, but the Dow and the tech heavier NASDAQ as well, is just how much of this is a momentum play on those key parts, the most heavily parts of the market that are weighted in the index. I think technology, I think consumer discretionary, and I think of communication services as those kind of three, the three that stand out the most. From your perspective, seeing the flows that you've seen, is that something that has durability, or do you feel as though this so-called broadening out trade is lending at least some people at the fringes to go beyond that towards this kind of rebalancing element of trying to find other sectors that may be due for a so-called catch-up trade?
Well, the catch-up trade, I mean, you framed it really well. I think that the momentum is definitely playing a role. How would you not want to participate in the growth of AI technology? Everybody has been waiting for the cycle to change from growth to value. I don't think it's happening just yet because of the momentum that is really fueling these big indices, these big sectors that are powered by AI and technology. I don't think that the rebalance trade is going to happen until we see a signal from the market indicating a slowdown in these big trends. Because for as long as AI continues to build on that momentum, it's going to be really hard for investors to understand you need to step away. Now is the right time to step away and diversify. You know, the entire concept of momentum is really interesting because you are telling people to step away from something that they love, from something that is producing the outcome that they want to see at the point in time where the stock, when the sector, when the industry is really hot. So I do think it will take a little bit of a market correction. It will take a couple of cycles of earnings calls and earnings results showing a slowdown into these trends, into these sectors, for investors to really start spreading out. Now, I don't know, I mean, markets have been so strong and continues to be so strong. We have seen signals of the S&P 500 crossing 6,900 points. There are analysts that predict that the S&P 500 is gonna hit 7,000 points, 71,000 points before the end of the year. The same with the Nasdaq 100 reaching all-time highs. So when markets are so strong, it's really hard for investors to spread out horizontally. I think it's going to happen, probably not this year, but at the beginning of next year, there will be much more focus about diversification.
Todd, to follow up on that point, if you are looking for those initial tea leaves or those signs that we could see it perhaps some kind of a downdraft to the market overall, what exactly would we be looking for out of the marketplace right now? And I say marketplace specifically because at least at this taping, at this particular show, the government is still shut down. We still don't have data coming out of the government, but for tiny bits and pieces, the CPI this past month being the exception. What exactly are the investors out there kind of keying a little bit more on thematically from a markets perspective, from an ETF perspective, that get them to feel as though they may want to reposition ahead of a potential bigger event that happens? What exactly would we be looking for?
Well, we've seen some of it. So the Healthcare Select Sector Spider ETF, XLV, which has been out of favor for much of the year, started to return to favor in October, both from a performance standpoint on the underlying stocks, as well as flows going in to that ETF. So it still has net outflows, but it started to see a pickup. We've seen stronger financial results from some of the healthcare, the leading pharmaceutical companies that reported results last week. Healthcare tends to be a more defensive sector. So we're watching to see if people continue to gravitate towards that as a way of diversifying away from some of those sectors like technology that you touched on.